Hey, Jason here. Let's talk about how to buy property with seller finance. Okay, this is something I personally did back in 2019. It was actually my first ever deal. It was a seven-figure deal out in Nebraska. Those of you who know my story know I was broke. Okay, I was literally sleeping in my rental car. I found a motivated seller. I worked a deal. 88% of the purchase price, which was just over $1 million, came from seller finance. It was a seven-figure first position seller finance note. I'll talk a little bit more about what that means later in this video, but I want to talk to you practically about how to go about securing seller finance to help you buy property. Now, here's the nice thing just before we get into the details. Property is a great asset from which the seller should consider financing. Objectively, it makes a lot of sense for a seller to finance or to carry paper, as it's sometimes described. You can hear owner finance, seller finance, or the owner or seller carrying the paper. All of those terms are basically seller finance, just to start there. But first, let's talk about why it makes sense for the seller to finance the deal, because this is going to be important for you to communicate to the seller as you go through the deal making process, right? So you go out, you find a property that you like. Maybe it's an apartment building, maybe it's a mobile home park, maybe it's a portfolio of single family houses, fill in the blank. But you need to understand why it makes sense for the seller. Obviously, you know why it makes sense for you, right? It's easier to get the money. It allows you to essentially deal right with the seller to secure the bag, the finance. So, I mean, it's easy enough to explain why it makes sense for you, right? You get to cut out the bank, and the process of closing is much more simple, much more seamless, happens a lot faster. Okay. So, those are all reasons why it makes sense for you. But let's focus on the other side, because without that seller willing to finance, and the right seller willing to finance, right? Because it's about securing the deal on the right price at the right terms for the right property. It's not like any old seller finance will do. You want, again, the right property, the right location, the right metrics, the right types of tenants, if you will. There's all these other variables. But when you find that perfect opportunity or that great opportunity, the reasons why it makes a lot of sense for the seller to finance the property are as follows. Number one, awesome tax benefits. Okay, if you sell and talk to your CPA about this, but if you sell property or a business, or really if you sell any asset all at once, if you've made a lot of money on the deal, say you bought the property at $500,000, now you're selling it at 1.5 million, then you are going to be subjected to a million of capital gains. That's $1 million worth of capital gains, and capital gains is taxed at a very high rate. That seller, if you have $1 million earnings that have taken place through the life of the hold period where you're holding this asset, in this case, a property, I mean, you're going to be writing a multi-$100,000 check between the feds and the state. I mean, it's a huge tax hit that you're going to take. And I've dealt with sellers who, on the other side of the coin, have received a considerable sum of cash at closing, and then they cry to me the next following spring about how much they're paying in taxes. So by striking a seller finance deal, you sidestep all of that for the seller. Because a seller finance deal, just to describe it here for you, a seller finance deal is real simple. You're going to pay the seller over time. It could be over 3 years, over 5 years, over 10 years. You can negotiate the interest rate. You can have the loan be fully amortizing versus you can have a balloon where, say, you're going to make payments for 5 years and then you're going to, have to pay in full. But the punchline is the seller is going to defer capital gains and is going to be paying over time. And by paying over time, they're going to reduce their tax liability, and they're really going to save a ton of money by not giving it away to the feds and to the state and to all the other government bureaus that have their hand out, right? Talk to your CPA for the details on this. But I mean, seller finance really helps the seller avoid taxes. That's one, you have to emphasize that to the seller. Number two, understand as well that there's massive amounts of interest income that the seller will make by engaging in a seller finance deal. Okay. I mean, run it through a loan calculator. When you amortize over 10 or 15 or 20 or 25 years at a 5 or a 7 or a 9 or a 10% or even a 12% interest rate, depending on what you negotiate with the seller, all of this is negotiable, of course. But you run that through an amortization schedule, an amortization calculator, and what you're going to see is the seller is going to make a ton of money in interest income. In fact, any amortization schedule that you look at, you're going to see almost in all cases, the vast majority of the initial payments that you'll be making to the seller in the months after you close the deal, it's almost all going to interest. So if you're making those just the base payment every single month to the seller's hardly even reducing the amount of the total note that you owe as the buyer. The seller's just collecting interest income. So you basically are able to generate a brand new stream of income for the seller. And in many cases, this is really advantageous for sellers who are aging, who want a consistent income, who basically are ready to retire. Let's just say it for what it is. It's that consistent check every single month. And what's great about real estate and why real estate works so well for seller finance is if you ever go crazy and don't make the payments, then they get to reseize the hard asset, the property or the properties that the deal is collateralized by. And this is why seller finance works really well in the real estate game is you have this beautiful combination of massive tax benefits, interest income up the wazoo, combined with a deal that's actually legitimately collateralized by the asset that's being transacted. And that trio right there is gold. So these are the things you want to emphasize to a seller. But this is the mistake I see a lot of my clients and people that I know who have gone about trying to secure seller finance. The mistake that most people make is day one, right out of the gate, they put their cards on the table and basically say, I want to buy your property and I want you to finance it. In this, it causes all kinds of problems. Okay. So number one, it's far too transactional for most sellers. And I'm talking about sellers who are selling maybe a $500,000 property up to say a $3 or $5 million property. That kind of perfect first deal that a lot of you may be looking to get done, or one of those first few deals as you build your portfolio and start building wealth. So if you're way too transactional about it and you just come right out and ask for the seller finance bag right out of the gate, my experience and the clients I've worked with and people I just know from being in the community, pretty much everyone will tell you, usually it spooks sellers because what it subcommunicates about you as the buyer is one, you aren't credit worthy. Two, it's very transactional and doesn't have any romance associated. And thus three, and ultimately the seller just rejects you and usually looks in a new direction to sell the property. They don't see you as a credible and legitimate buyer. Okay. So what you want to do instead is firstly speak to the seller about the property itself, build a bit of a relationship with the seller. This is a huge and understated and underemphasized point when it comes to securing seller finance. And this is exactly what I did when I ultimately secured the 7-figure seller finance note that I told you about that really got me into the game of building my portfolio of now properties and businesses that I own. Right. But I built the relationship with the seller. I believe I spent about 5 hours with him the first day I met him. And funny enough, he actually told me that the most he'd be willing to finance was 20% of the deal. It was a mobile home park out in Nebraska. He was willing to provide back end seller finance, something we haven't even talked about yet. Because right now, what I'm talking about is first position seller finance, which is the bulk majority of the financing. It's 80% or 70% or 90% of the purchase price. Think about essentially like a mortgage for a home. That's first position finance. What does first position mean, by the way? First position means if you ever don't repay, the first position lender gets the first lien rights to the asset. Usually they get to reseize the asset or they get to get fully compensated for the amount of money that you owe them, the lender, right? So first position seller finance is very much on the table with real estate because, again, if you ever don't pay, they get to reseize the property or the properties at hand. Second position seller finance is what this initial seller that I worked with suggested he was willing to provide. But I believe what happened over time, well, there are a number of things that happened, some of which are a bit confidential. I won't share them all on this video. But one of the things that happened is he and I got to know each other. He saw that I was very serious about the process of going out and buying this property that he owned. He saw that I was very committed to what I was intending to do. And I believe over time, he saw the way I conducted myself, the way I handled myself throughout the deal making process. And he became, I believe, more confident in my ability to professionally handle the property and to be the new owner. Of course, I also shared things with him like my credit score, which I showed at the time was over 700. So, in other words, I didn't have bankruptcies in my background. I didn't have all this chaos in my life. I didn't have a lot of money. In fact, I was pretty much broke at the time. I did have an investor that was backing me, but it was only for it was about 10% of the purchase price that I had the investor in for. So I needed the other 90%. And that's ultimately where the seller finance note I'm describing came from. But a lot of it came from that relationship. It came from the relationship. But once you build that great relationship, unless if the seller is bringing up seller finance to you, I recommend going about your business and intending to secure traditional finance. And this may seem like a long way to roam, and in a sense, it is. But at the end of the day, usually sellers only really become interested in financing the property if their deal is not particularly financeable. Now, if you build that relationship with the seller and you want to state your case for why seller finance makes sense, by all means, do so. And in some instances, for the aforementioned reasons, the tax benefits, right, the interest income, and the speed of closing, combined with the consistent monthly check that the seller is going to get, that really is great for retirement. You may get the seller, after you build that relationship, to agree to seller finance. But normally, if you go about the process of trying to secure finance through a traditional means, and then throughout the process, there is a problem with securing the finance that is related to the deal not being financeable, that is when it's easiest to secure seller finance. And that's essentially what happened in my instance and in my example. Ultimately there were certain items that made the lender uncomfortable with financing the deal. I made these items, known to the seller, and at that point, there was a newfound leverage that was created from my perspective as the buyer, where I was able to basically say, "Hey, I spoke to most of these lenders in this side of the state. They aren't willing to finance the deal. These are the reasons why. These are the things I'm not going to discuss on this video, but there were reasons why the lenders were unable and unwilling to finance. Thus, hey, Mr. Seller, why don't we do a deal in a different way?" Boom, here's a new opportunity, here's a new offer. That is a tried and true battle tested way to secure seller finance. Yes, it's the backdoor route, but when you demonstrate to the seller that you're being as proactive as possible at securing finance, and then if you're unable to secure finance, most notably because of reasons that, you know, relate to the seller, it could be a CapEx issue, it could be a misalignment between P&Ls and tax returns, it could be because of the age of the property, it could be because of the location of the property, perhaps it's more rural and lenders are uncomfortable with lending in that area. It could be perhaps it's in a floodplain zone, which I'd be wary of, but do as you see fit. I'm not going to talk about diligence on this video. But if the reason or reasons why that lender is unwilling to finance are tied to the seller's asset, in this case the property, then that is the perfect tie-in for really reverse engineering a frame of logic, which basically suggests, hey, Mr. Seller, it makes sense for us to do seller finance if you want to transact here. Whereas if it's you that is the reason why the lender is unwilling to finance the deal, then of course you have less leverage. And while you can of course ask and position yourself as professionally as possible in attempting to secure the seller finance, your odds are lower. Let's just call it for what it is. I wanted to add real quickly here that if you're unable to get the deal done because of your own challenges, credit wise, then there's a few things you can do, right? Number one, you can raise more private equity. And I'm not talking about private equity like a private equity firm. I'm talking about private equity in the form of an LP investor, a limited partner. Think of, the $50,000 investment from an accredited investor who works in software or in SaaS, or a $100,000 investment from somebody who's well off, who's a retiree, who wants to get their capital working for them, right? You can go out and raise more down payment, and that can potentially get a traditional lender to basically lend because there's more equity in the deal. And it can also then get a seller to be more comfortable in doing seller finance because there's more equity in the deal as well. It delevers the project, right? Another thing you can do potentially is go to somebody who has a strong income or streams of income, multiple streams of income, or a high paying W-2 job, and get them to co-sign on the deal. Get them to co-sign on either the seller finance note or of course the bank note if you go that route, which then also brings up the idea of, if the seller is unwilling to do a first position seller finance deal, then you can look to get them to agree to second position seller finance, whereby, for example, they'll get 80% of the purchase price at closing, but then they finance the back 20% over, say, 7 years on a fully amortized loan at 8%, for example, right? So we've been talking in this video primarily about first position seller finance, but you can also work in second position seller finance. Second position seller finance means basically if you ever default, then the primary lender, Bank of America, let's just say, and I don't recommend working with big, lenders like that. Normally smaller lenders are more competitive for these types of deals. But let's just say in this example, Bank of America is providing 75% of the capital. You're kicking in 5% for a down payment, and then the seller finance note is for the final 20% of the purchase price. In the event you are unable to pay Bank of America, then Bank of America would get the first lien rights to that asset, which means essentially they're going to repossess the asset, the property, and then sell it. Which means essentially that 20% that the seller financed on the back end of the capital stack, in other words, the second position loan, yeah, they're probably never going to see that. So second liens or second position notes are more risky than first position notes, because first position means you get the first position to the asset if things get dodgy. Second position means you're second, third, et cetera, et cetera. But the relationship's really the key. And it's not just, look, it doesn't have to be a pretend relationship. I'm not telling you to pretend to be more interested in the seller than you are, but even just basic open-ended questions to the effect of, tell me more about the property. Tell me about how you bought the property. Tell me about some of your favorite things about owning the property. Tell me about some of the worst nightmares you've had during your tenure as the owner. Just asking these open-ended questions can often lead, and those of you who've done deals before know this, you'll sometimes, when you ask just one of those questions, you'll get a seller that will go on for 10, 15, 20 minutes with their answer. They'll tell you stories. They'll tell you stories of hardship, of their blood, sweat, and tears. And in sharing those stories, sometimes a seller hasn't really had an opportunity to share a lot of those stories. And when you suddenly are a willing and interested audience, and you're listening attentively to these stories and these these real personal stories that the seller's telling you, in a sense, it builds this bond, and then suddenly you're interested in taking the reins and continuing the legacy of this property. And this is really where that rapport is built. And it's not a fake rapport. You're not pretending, they like the Buccaneers. Oh, I love the Buccaneers. They love croquet. You love croquet. I'm not telling you to fake it or to pretend you're interested in something that you're not. Simply asking those open-ended questions and taking legitimate interest in the answers, I found to be a very effective means. It's authentic, it's sincere, it's not BS, and it really does build that real rapport. And if you go about building that natural rapport, and then either after having done so, you make a legitimate offer with regards to seller finance after you've educated the seller, or whilst educating the seller as to the benefits, right? So in other words, don't make a seller finance offer before you've educated them to the benefits of seller finance. Preferably, you educate them to the benefits of seller finance, and then after the fact, make the offer. And again, emphasize, hey, Mr. Seller, before you say no, I love this one. Hey, before you say no, talk to your CPA about the interest income associated with this offer, as well as the tax benefits that you're going to receive relative to receiving, this sum of this purchase price in cash, right? Talk to your CPA about the differences between, getting paid this amount over time at X interest rate over Y number of years versus receiving this sum in cash. And really, you can even, if you work with the CPA and learn about the state and federal tax rate that you're that the seller would be facing if they sold and received cash, and then you run that model versus the, hey, here's how much you would make versus in the seller finance option with this interest rate, these terms, etc., and you break down the difference. You're gonna, in many cases, even for just $1 million deal, you're dealing with hundreds of thousands of dollars in a difference. It's a massive delta. It can be upwards of 25, 35, even 45% more, in the effective sum that the seller is going to keep in his or her bank account post close. And at that point, it actually becomes a very compelling argument. And as long as you don't press, and like any good sales, Donald Trump wrote this, love him or hate him, he wrote about this in the art of the deal, the takeaway close, right? The takeaway close. So as long as you're not too needy, but rather it's, hey, take it or leave it. I'd like to have an answer to this, and I do need an answer to this by the end of the week, by Friday at 5 p.m. Eastern. But hey, I think this is something you should consider, right? As long as you deliver the offer in a professional manner, preferably in writing, of course, in the form of a term sheet or an LOI, or even you can go right to an asset purchase agreement. Again, other topics for another video. Make sure your offer has a deadline. Very important. All offers should have deadlines. Otherwise, you get shopped. It creates all these other problems. But if you put the offer forth in a professional manner after having educated the seller and after having built a relationship with the seller, you really have a puncher's chance with property. It's much harder with business acquisitions. I have a lot of my clients that do business acquisitions and they struggle with seller financing in comparison because there's that lack of collateral. In a business acquisition, usually there's some trucks or there's some inventory, there's some furniture, but that's about it. With real estate, you know, the deal is the collateral. It's a hard asset. And so that's really the key that makes this a legitimate opportunity for you to get done. Okay. So that's really the punchline. If you want me to make more video content about this, let me know. I can do so. Otherwise, if you're an accredited investor and you'd rather me do the hard work instead of going out and finding these deals and negotiating and all of that, and then operating them, of course, after the fact, go to brighterutilities.com. We do put together investment opportunities for accredited investors. And if you'd like me to help you with buying properties and businesses, between myself and my clients, we've done, well over a dozen deals and we're always doing more. So if you'd like me to help you with your deal making endeavors, go to jasonpaulrogers.com. Share this video. If you like this, share it with somebody that's interested in business and buying properties or businesses. Like the thing, share your comments below, subscribe, hit the notification bell, and I'll talk to you in the next one. Thanks for watching. Bye-bye.